Hello everyone, it's me the Boss Hog, and we're back with a portfolio update as of the end of February. If anyone watched my recent video detailing the videos that I'm going to be making over the next couple of months, this is basically the first in that series. So I've changed quite a lot and I've introduced a bit more data. Hopefully this is going to be interesting, but it's going to be everything happening in our Trading 212 portfolio as of the last month. Let's do it. All right, so in terms of the current situation, I've just got my snapshots here from my three Trading 212 portfolios. That's two ISAs, one for my wife and one for me, and then a general investment account as well. My general investment account just has one position in for Games Workshop, and it was originally my emergency fund, but in the medium term, I'm going to sort of do a proper emergency fund, because obviously you shouldn't have emergency funds in shares, in my opinion. But it's in progress to do this year. So the way to read this is ultimately the Trading 212 figures here should match with this column over here, and then the Google Docs document figure, that's the basically what my own spreadsheet tells me. Typically, I want those figures to be within, fractions of percent of each other. The reason why they'd be different is sort of after hours trading tends to be a big one, as well as sort of any rounding, or sometimes especially Google can be a little bit slow updating one or two of the price points for smaller stocks. That can work in my favor or against. So as long as it's around the same figure, we're pretty happy. And then everything else beyond that column, including P&L, is basically calculated in real time based on Google Finance sheets, etc. So broadly speaking, we still have a fair amount of cash. I added when Trading 212 introduced 5% on cash because it's tax free. That's basically the best I can get. And I've gradually just been winding that cash position down. My buys, and we'll get into the detail fairly shortly, but they've been focusing on a couple of positions. So SMT, Scottish Mortgage Investment Trust, ATT, Allianz Technology Trust, THRG, that's Throgmorton. That's a sort of UK-focused quality stock position, I would say. I believe that UK equities are quite undervalued at the moment, and therefore I'm happy to buy into that position. And then GDIG, which is my mining ETF as well, which has come definitely under a lot of pressure over the last few weeks slash months. And we are averaging down into this currently between about 4 and 8%, depending on what's happening in the market. So we've been using it as an opportunity to add to our position on that. In terms of the cash, although I'm running slightly ahead of schedule, I'm happy to either keep it as cash or buy quicker if I see any buying opportunities. Trading 212 recently increased their interest rate to 5.2%, so we're very happy with that kind of return as well. So this is an overall snapshot of how things are looking. It's been a really good year, week, month. It's all moving in the right direction there, as you can sort of see with the week on week and the 4 weeks, etc. So all of those figures will update as we do this month end process. So yeah, very pleasing direction of travel. And after a relatively difficult start to the year, February was very smooth for me, honestly. The only slight drawback is that I can't keep up with the S&P at the moment. However, I am comfortably beating the FTSE 350. And although we're year to date behind the MSC All World, which is our other comparison, overall we're still comfortably ahead on them as well. And we've got some graphs further in this video to detail that a bit further. But there's current situation, so we're approaching our 200k figure, as well as having 100k in each of our ISAs, so that feels pretty good as well. Okay, so we remain pretty top heavy in terms of our portfolio. This is my complete position, all of the holdings that I have, regardless of what ISA they sit in. And then there's the cash position as well. So you can see here that still got 2.5% in cash, 97.5% in stocks. And you'll probably notice that there's a long tail and a very top heavy weighting. And if anything, over February, my portfolio has become more top heavy just because I view Allianz especially, but also SMT as very easy buys at the moment. So I'm shoveling as much money as I can in there, despite the fact I'm averaging up quite a lot. And then at the bottom, where I've been sort of moving money around and sort of selling, which we'll get to in just a second, but I would plan to rebuild into these positions. But in the moment, I wanted to find as much money as I could to throw at positions that I considered undervalued. So that's when that's the approach here. But as a result of that, my portfolio has definitely become quite top heavy. However, my largest single position there, Gamma, is just under 10%, similar with Amcor. So my two largest positions are quite broad based, I would say. Even though SMT is considered a tech fund, I would actually consider it a consumer discretionary fund. I think it's fundamentally misunderstood. Allianz Technology Trust, definitely a tech fund. So we're very happy to have sort of tech and consumer discretionary, and you'll see in my portfolio weighting, those are by far my two biggest slices as well, contributed to by these positions. So yeah, that's absolutely fine there. Um, I do have a medium-term plan to start broadening my ETF and investment trust positions, really just going a bit more global, a bit more generalist. I now have quite a lot of money in my ISAs. This is sort of about 40% of my overall wealth, so not a small amount anymore. And so I think it does make sense to start broadening. I have already started down that journey if I look at things like global infrastructure. And I'm starting to look at emerging markets as well. So I do plan, like I do enjoy those investments. Even infrastructure, I do find kind of interesting, the return on investment, etc. Emerging markets, I likewise find generally quite interesting. So I'm quite happy to and want to build positions in there. But I'm not seeing a ton of sort of material underpricing and opportunities. So compared to, again, Allianz and Scottish Mortgage, I'm just putting a bit more money in that general direction at the moment. I have been buying a bit of India, have been buying a bit of Canada and the Netherlands as well, so some geographic exposure as and when I could. But still, the majority of my buys have been focused on the top positions with that in mind. So we'll see how this changes over the year. Again, I'm not beholden to these. So, if Scottish Mortgage suddenly dropped 10% for no obvious reason, I would absolutely find as much money as I could to just throw it in that general direction, right? I don't care if SMT ends up 25, 30% weighting of my portfolio. What I'm kind of trying to focus on at the moment is ultimately putting my money to the best use I can find. So that's the approach here. This is how it looks currently, and we'll see how this changes over time. All right, so now some graphs. I know some people really like graphs, so here they are. So in terms of my portfolio value, you can see it's gradually been a general direction of travel. It's probably worth including this graph as well. So for anyone who's new to my channel, I started effectively with a big bang after my wife decided to go back after maternity leave. We had sort of £40,000 saved up in cash, and we more or less chucked it in one go into the stock market, so hence the big jump at the beginning. Since then, it's more or less been gradual, averaging in as fast as I could. That's not because I'm sitting on hundreds of thousands of pounds. That 40,000 was as much cash as we had at the time, and then we've been looking to add sort of about £3,000 a month, something like that. But the top left graph is impacted by the market generally, right? So that's my total overview portfolio value. So that's going to be impacted by how the market is. So you can see a pretty sharp drop and then gradual recovery, and primarily for things like inflation and the Ukraine war, etc. So, and then if you look across the graph next to it, the portfolio over time, I think that's a bit more indicative of where the falls are coming from. So here the green is my capital, the blue is growth, so that's capital appreciation. That can be from sold positions, so realized positions, as well as unrealized positions. So that's my total capital growth, whether it's already been realized or not. And then the pink here is the dividend. So the dividend figure will never reduce, it will only ever go up. And for me, that's going to be exciting to see how that develops. But you can sort of see the same pattern, right? It kind of drops down a third of the way through the graph. And we actually are then underwater for much of 2022, as I suspect many people were before 2023, and now into 24 has shown pretty solid recovery. And we're up comfortably at the moment, so that feels great. This is also interesting from my perspective. So this is profit over time. There's a couple of observations I'd make here. Like, first of all, when I look back, especially right to the very beginning there in the early days, like I remember in late January, early February of 2021. So I've been invested in for like a matter of weeks. And I was up to like £300 profit, and suddenly all my profit just went. And I felt pretty rough at the time. I was like, have I just messed up, right? Like I had that initial immediate reaction that I think many people have. When they first start investing, and now I look back and you can't even notice it. You sort of see a few drops. You obviously see the big drop there, which again is a certain war. And then because I had quite significant exposure to UK listed but Russian focused miners, I was heavily impacted on that. And you can see the blue bar, which is my UK listed positions, took a very long time to recover. And has really only started to become profitable over the last few months, although it's now bouncing back quite strongly. And I actually think that there's a lot of potential in my UK listed positions. Like, I'm really bullish about UK equities. And it's just a value perspective, right? Like, I know that Sage isn't going to suddenly compete with Google or something like that, right? But there are some really good listed companies that are completely under the radar and are way cheaper than their American sector. And most of the time, equivalents from that perspective. So it was a fairly challenging 2022, and the recovery's been fairly uneven, right? We've had a couple of sort of false bull runs, but now we're at all-time high profits now. To be fair, I mean, I'm doing this at the end of February, but it's already gone March the 1st, and so again, March the 1st was also a fantastic day for me. So I'm hoping that this is just going to continue to climb ultimately. Next up, I've said before, and I'll say it again, this is my most important graph, I would say, because ultimately it's how I'm comparing against my benchmarks. So the blue line here is me, and we are still second. I would say I've lost some ground against the S&P, especially in January, February this year. You can sort of see there it's had a very strong start to the year, but we are still comfortably second, still comfortably ahead of the all world, which is reasonably far behind. And then, we get into things like inflation. That's UK inflation, by the way, from the Office of National Statistics. So that's kind of incredible to me that over, a 4-year time span, 3-and-a-bit-year time span, that's the power of inflation. 20% is crazy. And then we have the FTSE 350, which hasn't performed super well. You can kind of see in the middle, actually, in 2022, it was at one stage ahead, and that's because of its defensive qualities. But actually, in the long term, it hasn't really held up particularly well with the S&P especially. So I'm about 50-50 split between UK listed and American listed. So maybe it's to be expected I'm somewhere in the middle. But again, even my UK companies, I don't have a ton of what I would class as blue chip. Probably my best known blue chip would be Legal & General, fairly small position. Phoenix as well. Phoenix Group is large but not well known, but FTSE 100. And then I've got a bunch of sort of FTSE 350 and AIM listed shares within that as well. So yeah, it's a little bit like atypical, I would say. I don't really follow the FTSE 100, especially I don't have anything in oil majors, nothing in defensive industrials or anything like that. So there's again fairly atypical against the FTSE 350, I would say. And then last but not least here, my sector with ETFs broken down. So this is a little bit simplistic, but what I do is I basically look at my ETF or investment trust position, say, for example, Scottish Mortgage, and then because they're heavy weighted in consumer discretionary, that's where that position goes. Similar for ATT and things like my Canadian position would go under financials because it's heaviest in financials. So this is the breakdown, basically. Again, there's a little simplification in that, but I think it's a good immediate eyeball of where the focus is. So I think I maintain that there's some good opportunities still in consumer discretionary. I think some of the restaurant groups or some of the cafe groups, if I think of the likes of Greg's in the UK or your Texas Roadhouse, are potentially really good. Domino's as well, I think, still represents a good opportunity. And then I really like things like Games Workshop, that I think is just an incredible company in that sector. And then technology at the moment is kind of crazy. I mean, I don't have any direct exposure into Nvidia, but because Allianz and Scottish Mortgage, both of them have it as their second largest position. Then I've got a semiconductor ETF that has it as its largest position. So actually, I've got like almost 5% of my portfolio in Nvidia by extension. So needless to say, I'm starting to pay a lot more interest to Nvidia at the moment because it will have a notable impact on my portfolio as a result. I do also have fairly big bets into Amcor as well. Bit underwhelmed by their latest results, if I'm honest, but again, I'm hoping in the long term that's going to look great. And a smallish to medium position in ASML as well. I wish I had more, frankly, but we're enjoying our position there all the same. So this is where I'm most exposed. Pretty happy actually with my utilities and financials position, especially because utilities is mainly Gamma, so a small listed UK company with a European exposure. And then financials is a bit more broad-based, a lot of insurance in there, and actually some of my more dividend-yielding stocks, which is absolutely fine as well. So these are my stats, how they're looking across the time period. And to be honest with you, I made these as I took out the x-axis on this just to, when I first created my portfolio. But as time's gone on, it's kind of now 3.5 years. So a lot of stuff has happened, and it's not immediately obvious to anyone who hasn't been here for 3 years what the journey is. So I may well put the x-axis back in for next video, just so we can sort of see the journey and what's been happening without me having to explain it to anyone new. But this is ultimately my most important stats as I would view them. All right, so in terms of transactions, I have been quite busy over February. We're going to start with our buys. I would describe them as quite broad, but you can see here like a very heavy top-heavy buying pattern. So Allianz I've already mentioned here. My average of 332. I'm absolutely delighted with this average. Again, I have been averaging up very aggressively. So my average is sort of 270. I first got into this stock at like 203, but I've been averaging up, and again, I will continue to average up. It did have a little bit of a late run at the end of February and start March, but still, I think there is an argument to continue to put money. Top two positions being Microsoft and Nvidia just doesn't feel bad at all. So yeah, there's some focus there. Then I also decided to make a bit of a bet actually just before Nvidia published their results. And my thinking here was that one of two things would happen. Either Nvidia would again continue to smash, in which case this would go up immediately on a fairly sizable buy, or it would go down, in which case, it's fairly sizable, but it's not huge, and I could put some more money into it. But I lent more toward the former, and I was quite quickly rewarded. Actually, I'm already up like 10% on this position. I've only got about 4 and a bit thousand in, so I've sort of 10x'd my position effectively with this buy in the semiconductors. But decided that again I really wanted longer term exposure to it. Similar kind of argument with Throgmorton, really. Like I was buying, like my average here of 596 is kind of interesting because I was buying it both before and after the ex-dividend day, and it's quite a chunky dividend. It's 12p a share or 11.5p a share. So my thought here was that I was buying below £6 if I was entitled to the dividend, and then below 588 once it went X. So that's my viewpoint. However, again, this is still quite a decent NAV discount of about 8%. I think a lot of the companies here are potential takeover targets, or they're just really high quality companies that will continue to throw off cash. And when you look at Throgmorton's prospectus, like their last year's results, you can really see a sort of steepening things like dividend, cash flow yields, that kind of stuff. Like they sit on a lot of very high quality companies, I would say. So if anyone takes them out, then great. They used to have a position in Decra Pharmaceuticals before they were taken out, and I would say half of the position looks very buyable. So either we'll have that win if somebody snaps them up, or it's a long-term hold that's going to start throwing off a lot of cash and be a good value play. So actually, like the current price at the moment, I was buying some stuff in the 570s toward the end of Feb. So that felt really great for the future. I'm very comfortable with that, and happy with the buys overall. Then we have SMT. Again, still quite a lot of buying. I mean, this was only an extra sort of 10% on top of my position, but very happy to be buying this. And similar with my global exposure to mining, this is my only mining position now. So it was, I guess, unless we count Everaz, which is frozen, but it's my only real mining position at the moment. And so, having sort of 5% of my portfolio in global mining, commodities hedge, etc., doesn't feel bad for me in the long term. And as it's an opportunity to average down, whilst the sector is a bit unloved, I've been taking that up as well. So the rest here is sort of either a combination of value plays or things that looked like reasonable buys. So I'm actually relatively happy to start putting a bit more money into my Indian position as well, up very slightly on this at the moment. It has a fairly large spread as well, so when you buy big you sort of take a couple of percent hit, which doesn't help. But overall I still think that there's a lot of potential in India in the medium to long term. So again, I think this might end up a bit of a play on my emerging markets, if that's the right definition for India, which I think it still is. In terms of sells, though, we were a little bit aggressive here with some of our sells. So just 3 positions, but you can see my sells were quite significant. So I'll actually start with my REIT position, which I think is the easiest to explain, where in the past I thought like, interest rates are going to come down quite quickly in 2024, but I sort of reassessed, and I think I got in there slightly before the wider market average did. So I took a reasonable profit here on my real estate position and redeployed it elsewhere. So, and right now that sale is the correct decision. I would have been worse for it, and freeing up this money and putting it into my semiconductor position and Allianz position was an immediate win as well. So this, like, you shouldn't necessarily just focus on the month, but this felt very defensible to me. I think I made the right call. I still think I made the right call. And even though I like REITs in the long term, I really like that this particular position has 10% in Prologis, so that feels good as well. I really like that REIT, but I think there were better places to put my money to profit take, and we will be revisiting this position in the medium term, but for now I think it was a perfectly defensible sale. Let's also then look at banks. So I started to build this position when I sold Huntington Bank shares, which was my regional play of choice. And that was because I basically had a big fall with the Silicon Valley, and I was a bit mentally scarred from my Russian miners and sort of bag holding. So I decided to exit Huntington, but I still wanted exposure to the UK regionals, and this is a pretty good way of getting it. It's 1/3 majors, 2/3 regional, all US banks. And so we built a lot of position here, and we sold at sort of a 12% profit or so, so not huge, but we were pretty happy with our overall sell. We didn't sell in one go. We sort of sold it in a couple of tranches, but the long story short here is I went right down to one share. Again, I would consider buying this again, although I consider it relatively upped with events, to be honest. And then last year as our small cap, this was probably my hardest one to sell. But when I looked into it, it was basically trading in line with its NAV. We were comfortably up and have been comfortable. We've actually timed our sales on this quite well. This is my third large sale, I would describe it as. And we've been enjoying the dividends. We've been sort of taking a 6 to 10% win each time. And so at the moment, we're very green on this position, and we still like it. This is still part of our long-term play to get into small and medium shares. So we will be back. I don't really know hardly any of the companies in this at all. So it's always very interesting to me just to look down them. But again, that's why you're buying broad-based ETFs and investment trusts. So we took our money here and decided that because we thought that this position was fairly valued and other positions weren't, that we could find the money to buy the likes again of ATT and Arvanek here. So that was my rationale in what's been quite large movements. And by the way, the delta between the buys and sells is where I had a number of fairly large deposits in January, had a very large cash balance, and so have been unwinding. But we still have obviously a fairly large cash balance. And then in terms of withdrawals and deposits, so one withdrawal, this is for Games Workshop. So this is the one that doesn't sit in my ISAs, so it's not tax wrapped. And I had an agreement with my wife that we would basically withdraw whenever I got a GAW dividend and use it for a drink out or a meal out or etc. It was our anniversary in February, so this got put towards a fairly expensive meal and drinking session, but really enjoyable. This is sort of what my wife classes as cold hard cash. So she's with me on this journey, but it's quite nice to occasionally reward ourselves with this. So that's the rationale there. So we'll continue to take this out. It's also good as well because I'm a high rate taxpayer in the UK, so I can only have dividend income of £500 a year. So we're going to it's very easy for me to monitor how much is coming out and make sure I stay under that, so I don't have to pay 40% tax on this, which I will do if it ever goes above 500 in a year. So that's the thinking there. And no deposits. Effectively, we've already maxed out our ISAs. And we can't put any more in until the start of April when the new tax year opens up. So instead, we've been putting any extra money we have into premium bonds and building up our emergency fund from that perspective. But these are all of our transactions. By the way, I have been buying in fairly small amounts, especially, and selling in multiple tranches as well. So the way that this works from a visual perspective is we just take all of those averages. Where it's a USD position, the total is in pounds, and that's because that's ultimately what I was charged for it, and obviously my brokerage operates in pounds, so you might just have to do that. So the average price there is also in pounds as a result, right? Because it's basically total divided by number of shares, and that gives me my UK average in pound sterling as a result. So just to explain what those little asterisks mean next to currency there. But those are all of my transactions with the exception of dividends, which is going to get its own overview now. All right, so in terms of dividends, total dividends received to date since I started at 8.4k. And then February 2024, 277, which is much less than February 2023. I'll explain why very shortly. This is the breakdown. So you can see here Hollywood Bowl with a major contributor. However, I also had Hollywood Bowl as a special dividend in last year as well. Hollywood Bowl, basically, their policy is a 50% distribution rate, which is fine. But the way that they do it is they sort of do a fairly conservative interim and then final, and then they almost do a top up as a special. So I'm sort of expecting a yearly top up as a special dividend from Hollywood Bowl, and they only pay twice a year, but they do a special to sort of top up, I suppose, if there's any extra money available to keep in line with their 50% payout ratio. So I'm very bullish on Hollywood Bowl. This was a huge average up for me. I'm up like 45% on the position. However, I have done some preliminary work and would still maintain that it's a fine buying opportunity right now. So we will, again, trust the process, put money where we think it can go, and therefore reinvest our dividend into Hollywood Bowl. So they would have been quite low down on the buys on the previous. but that's the rationale there. And then Games Workshop are the other major contributor. However, Games Workshop really explains the difference between 2023 and 2024. So last year I had a much bigger position in Games Workshop, and part of the reason why I sold was to avoid tax, as the sort of anything outside of ISAs becomes very expensive for me to hold above fairly low levels. And I decided to take some sells as well. I sold a lot of my position at £1.15. £115 in Games Workshop. Is currently at something like 92. I would consider Games Workshop fair value at about 115. So that's why I sold a big chunk of it then. And as a result of just having fewer shares, basically. So last year, each dividend was 130 and I had 164 shares. This time it's 120 and I have 35. So that is really the main delta year on year. So totally fine. In terms of my dividends by year, I think the dividends by year is clearer to see. Like when I first started, I had a very heavy exposure to dividend yielding stocks. I was very heavy in things like REITs, utility companies, UK stocks. So much higher dividend yield in my early journey as an investor. Since then, I've become much less focused on dividends. I don't class myself really as a dividend investor. Dividends are nice. I definitely enjoy receiving them. They can especially feel good when you're averaging down things like T. Rowe Price at the moment. Whenever I get a dividend into that, I feel very comfortable averaging down into my position. And like they can make you feel good when you're generally beaten up in the stock market. I get it. One day I'll probably go back to a very heavy dividend exposure, like when I want an income stream. But for now, I'm not a dividend investor. So even though my portfolio value has more than doubled over the last few years, our dividend income hasn't really gone up that much. It is increasing still, and I would still expect it to increase in the medium to long term. But that's why it's got a much smoother trajectory as a result of basically reducing my dividend yield over that time. Likewise, as well, in terms of quarter, it's fairly all over the place. I've had some special dividends and things like that. And because I have a lot of UK shares that pay out twice a year instead of 4 times a year, sometimes that can create some really sort of flattering spikes. And other times it has the opposite, where I don't get anything for several months or very low periods. I do wish more UK shares were quarterly based. But hey, it's the nature of the market, I suppose. However, I did also want to share this as well. I think this is worth just discussing. What this shows is really the contribution to my dividends. So you can see here, the 84,000 figure there right at the very bottom for the total, and where our dividend is coming from each year. So you can gradually see that we are moving up here. The figures right at the very bottom for total will match with that yearly graph. And then the total active. So for me, I also thought this was kind of interesting. And of all of our active positions currently, only 67% of all of our dividend ever received is from those active positions. So 32% are from positions I've already sold, things like REITs, etc. in the past. And you can see here that it's again fairly top heavy. Like I would class Phoenix as a dividend position. Like I love the dividend yield here. 10% is crazy, super well covered. They have a massive war chest that I wish they would either use or do a buyback for. But in the meantime, it's a very well covered dividend and an incredibly well hedged and defensive company that we will continue to, again, average down on. Actually, this is probably another T. Rowe Price example where they are beaten up. There were also some reporting changes last year for insurance companies that really sort of screwed with people's understanding and valuations, I believe. And Phoenix isn't the easiest insurance company to get your head around either. A lot of sort of specialisms, and they're going into a journey from closed life positions into wealth management and pension books, etc. So quite different. But then we've actually got a couple of sort of what I class as small or companies like Games Workshop, not a huge company. Hollywood Bowl, that's technically a penny stock, about 650 million at the moment market cap. Then we've got MPW, which is kind of interesting because I'm down about 70% on that position at the moment. But hey, we do have some dividends coming in. So you can also see, and things like Gamma as well is sort of interesting because I would count Gamma as dividend growth. They have a progressive dividend policy. They want to do 11 to 15% each year. And because they've been growing faster than that, their payout ratio has gone from like 50% to 17% last I looked. So again, Gamma have a pretty large war chest at the moment, like 10% of their market cap is in cash. And I was commenting with somebody about what I want them to do with it. And for me, I don't mind them holding this money so much. A bit different to Phoenix, actually. Like Phoenix say they have a war chest, but it's clear that they're struggling to find buying opportunities that sort of give the right returns. But with Gamma, there's a lot of European regulatory changes over the next decade, most especially the sort of switching off of old analog lines that represent a very significant opportunity for Gamma. Their UK business looks 5 years ahead of their European businesses that they've been buying. So again, there's a lot of sort of accretive value that they'll be able to add as they move customers from legacy to more modern infrastructure. And therefore, I'm excited if they're able to pick up a company that's struggling. And they also recently bought a cyber security company that add to their sort of IT wrap as well, which for me, again, is a good use and offers a lot of value in the long term there. So there are like positions that I would say are more dividend focused, like Phoenix, dividend growth focused, like Gamma. You could include Amcor in that actually. They have a very, they raised their dividend 50% last year, so that feels pretty good. But then there are some companies here like SMT I could include in there that, it produces a dividend and it's not a trivial dividend just because my position is massive, but I would never buy things like SMT for the dividend because it's just not a huge consideration. So we'll continue to monitor this. For me, it's interesting the way that my portfolio has changed. But right now, I definitely enjoy this part of the video and all the dividends, etc. But it's not my primary focus, to be clear. Okay, and then to round out the video, I wanted to sort of look at a new data set that I produced, and I'm just going to call it a different perspective. I haven't really seen this in other videos or other brokerages. And what I wanted to do first of all is it helps me to see my P&L of my positions that I hold at least one share in. This for me is kind of important because, again, especially in the earlier days, I was a very active trader. And what that meant is sometimes, I would sell positions. And what you don't want to be doing is fooling yourself into thinking that you've made a good trade when actually 6 months later you would have been better holding them, right? So I think that was an interesting challenge to me, and this hopefully addresses some of that. I also kind of, especially where I've been averaging up into, again, Allianz and SMT, like that is an important thing to be able to do as a long-term investor. Like it's not always easy to average up. And sometimes you're almost tempted to average down into inferior positions. And although I think actually I've gotten pretty good at this, again, I think it is important to mature and to take that viewpoint. And again, this data really helps me do that, I think, in the long term. And then also, yeah, I wanted to kind of understand the movements that I've been doing. Even like if we take the example, right, with my real estate move or my S&P 600 small stakes move, what's that going to look like in the long term? And what this does is it basically shows me this view is at customer level, at portfolio level or position level, but each one of these holdings has a by month breakdown so that I can see. And I guess in this video, which is already pretty long, I'm just going to look at my top two positions to explain what they look like. But if anyone's interested in seeing the likes of Gamma or maybe Amcor and looking at sort of, either very bad or very good positions and what that actually looks like from an average position, then by all means ask. For me, like I say, this is going to deliver a lot of value. I hope in sort of addressing some of what I would call leaks. This is sort of a poker playing term, but like what I want to do is make sure that where I am selling or I'm averaging up or averaging down, that ultimately I'm not fooling myself. Like again, it's very important to keep yourself accountable and honest, and this is an attempt to do that. So first of all, this is all of my positions and the profit and loss from those positions. The profit includes everything. So my buys, my sells, my unrealized positions, my realized positions, and my dividend income, right? My true pound profit and loss. Again, it will factor into things like FX movements and things like that for non-pound denominated positions. So it should give a very overall viewpoint. The way that this works, by the way, is I download my transactions, which I already do in my Google Tracker, and then it's sort of just a fairly simple sum if calculation. So it looks at the transaction type, the amount of shares, the amount that it cost me, and by month. So it's just sort of bringing that all together, and then this is obviously the aggregate of that. So this is my summary. Again, if anyone's interested in any of these positions, whether they're good or bad or somewhere in the middle, please let me know. I also think it's worth saying that very few of these positions I've never sold. The most notable one is ASML. So I've literally never sold a share of ASML, which I find interesting because I have held it for quite a long time. Gamma is almost in the same one there, but it looks like I did a bit of rounding, so I sold like a fifth of a share. actually for a pretty decent price. But very few of these don't have any sales. We have to go a lot further down to the bottom for either very small positions or very new positions to find similar. But ASML are interesting to me in that I've never sold a single ASML, even part of a stock, which again to me is a conviction, which is quite rare for me to not sell. But again, this is my summary. Let's have a look at my top two positions in terms of their month-on-month detail. All right, so we're going to start with ATT then, which is the top one. So first of all, the average here is what Google Docs tells me. This should broadly match with Google. So 354 currently. And then you can see, like, I first bought this in October 2022, and you can see here my buy averages are really great. Sort of 221 is when I opened the position, and then I went pretty big on it on sort of 205. Evidently was the average, but I was buying sort of 201 and 203. That sort of volume there. I don't really recall what the sell was, by the way, but that feels like a long time ago. Obviously, if I hadn't sold that, I would be in a much better position. But overall here, because the share price has gone up so much, you can see sort of my buys in the early days, my margin on them is sort of 52 to 72%. So in a way, like you can look at what's actually in your brokerage, and maybe if I'd have stopped buying, after April 2023, I'd have a really great looking margin. I'd still be up several thousand, and it would be like a 60% margin, and I'd pat myself on the back. But ultimately, if I'd have done that, I would be missing on several £1,000s additional profit. And sure, like, the buys I've been doing in January and February aren't as profitable. January 302 average, February 332 average, but I'm still already up, and it's only been a month. In many cases for February less than. So this for me like really sort of shows the importance of averaging. Like if I look at my average in my brokerage or overall, you can see here that it's 29%, still very solid obviously. But really the figure that matters isn't the percentages, like that's kind of vanity. The thing that matters is overall profit. And again, for me here, like I don't really recall why I did these sales. The 203 here, I think actually the 203 with that one share was actually like a rounding issue where my brokerage forced me to sell a share. But this one in May 2023 was a deliberate sell, right? I sold 264 shares, got an okay price of 229. And again, the profit figure here, that doesn't mean I didn't make a profit on those shares, right? I would have been buying these at 211, 222, 221, etc. So I would have made a profit on them. What this profit figure is really telling me is whether I would have made more money by keeping them. And ultimately I would have, right? Because again, so this is actually a loss. Ultimately, I could have had more profit, and so by selling them, I have less money today than I would have done if I hadn't have sold them. At least in this position, right? You could make the argument that if I'd have put these sales in Nvidia, don't have Nvidia, but obviously if I had, then actually it would have been a fantastic sale because I would have got a better return, and that's what the overall summary is meant to illustrate. But on a position by position level, this is what it's telling me. So for me, again, it's making sure that averaging up is makes me feel mentally good. Like when I look back at this, it's like, okay, sure, I don't have a 60% margin. I only got a 30% margin, but what I do have is several extra £1,000 in profit as a result of that, right? Because I've been continuing down that path. SMT is actually one of my longest held positions, but you can see when I first started buying this, I was buying at £11, £13, relatively small buys, although my portfolio was less value in the past, right? So that makes sense. But you can see actually on those positions, most of which I've held for a long time, I'm actually down still. Until the share price goes to 13.37, at least one of these lines will be negative, right? All of my shares I bought in December 2021 are negative as a result of that average buy. But then I have dollar cost average or pound cost averaged into this. You can see like I did a couple of very big buys toward the bottom in the sixes. I did actually get some shares at like 630. I wish I had even more of them, but some of these feel 625 average there in April. So on those positions I'm up very comfortably. And some of these positions, like July, this is going to be a dividend month, so it looks a bit strange in isolation there with the huge 124%. But that's because ultimately I didn't have to spend any money to get the shares that I bought there, so it's a very immediate return. So it's 100% for the dividend plus the 25% share price growth since buying these positions. So this is also nice for me to see. Similarly as well, I did sell a little bit of these. I think this wasn't a good sell because I think I put it into my mining position, which since has gone down since December. But you can see here, like I did take a bit of profit, and selling at 720 meant that I was making money on my buys earlier in that year. But again, if I'd have just kept that, I would be up £125. And in this instance, a little bit more because again, that £125 has been diminished as a result of buying into a stock which has since reduced in value. So this is sort of, for me, there's a couple of nice things with SMT here. First of all, again, the importance of averaging in over the long term, especially, you know, like if you find a strong conviction. Like I still don't think SMT is expensive, but when it was down in the 650s, I was just like, this is astonishing. Like, this is such a rare opportunity to buy into a position. And by the way, because it's 30% private, I know some people don't like that, but I love it. It's my only opportunity really to put a large amount of money into private stocks. So for me, the fact that I have the equivalent of about 10 grand in private stocks that I would never have the opportunity to buy otherwise is also fantastic. And again, I can see here by the long term that even though we are down on our earlier positions, we're now starting to become very profitable on those positions where we were buying very aggressively. So, which again, I mean, you can see here, like buying 350 shares in February, that's not a small amount, but it was only, again, about 10% on the position. The big couple here are sort of in August and September last year. I added, you know, a couple of thousand, and those have been really good buys ultimately from that perspective. But still, I'm very happy to be buying at sort of 781 here, 792. These are all averages as well, right? So some of my buys were less than that. I think the best buy I got was like 770, and then some of them were as high as like 795. But we're happy with this viewpoint, and on these recent buys we're already up 3%. So although here we're only up 14% from a position that we've held for many years, actually the important thing is we're up several £1,000s, and again we're up especially on our bigger buys more recently. So that there's kind of an immediate win there, like, you know, being up 30% in just over a year. That's a pretty great return, right? So it kind of went, for me, it really helps with how I view averaging up or averaging down or sort of perspective, so to keep me honest. But anyway, I've got one of these for every one of my holdings currently. If anyone's interested in walking through one of them, just ask me and I'll put it into next month's video. This has been plenty long enough and my voice is starting to give out. So thank you honestly for anyone who made it this far. I've been the Boss Hog, and good luck with your investing. Bye for now, guys.